We're officially at the halfway point of 2025, and what a year it's been. The market has surprised many, inflation continues to cool, and investors are asking, what's next? Let's take a few minutes to break down what's been happening, what it might mean going forward, and why staying diversified continues to matter. This year started with a bit of hesitation. In the first quarter, concerns around new tariffs and global trade tensions rattled markets. We saw a steep decline in equity prices, but sentiment quickly shifted. May and June delivered a strong bounce, and in fact, it was the best May to June period for US stocks since 1950. They were up over 11%. But what's really interesting is that international stocks are still leading for the year, up nearly 20%. Historically, when we see strong performance in May and June, the back half of the year tends to be positive, but not always. So while it's a good sign, it's definitely no guarantee. One reason international stocks have been outperforming is a weakening US dollar. When the dollar drops, the value of international investments often rises once converted back to US dollars. It's a reminder that global diversification can pay off when currency trends shift. Valuations are high right now, similar to levels that we saw in late 1999 and 2021. Historically, high valuations haven't been great at predicting near-term performance. But when valuations are low, we tend to see much stronger returns over the following 5 to 10 years. So while this isn't a red flag, it is a time to be mindful about risk and reward. With everything going on globally, from tensions in the Middle East to election headlines, it's normal to feel uneasy. Geopolitical uncertainty can make even seasoned investors question their strategy. But if we look back at history, markets have shown remarkable resilience. Whether it was World War II, the Cuban Missile Crisis, the Gulf War, 9/11, or the invasion of Ukraine, the S&P 500 has typically recovered and moved higher over time. In fact, in many cases, markets began rebounding just months after a major event, even when the news felt overwhelmingly negative in that moment. This doesn't mean that volatility disappears, it means that long-term investors who stay the course tend to be rewarded for their patience. Trying to time your way around world events rarely works out, and often leads to missing some of the strongest recovery days. So while headlines might dominate the news cycle, it's important to keep your portfolio aligned with your long-term goals, not short-term fears. Cash has been pouring into money markets, now over $7 trillion. But while cash feels safe, it's lagged behind bonds, stocks, and diversified portfolios in terms of returns. In fact, 93% of bond funds have outperformed cash over the past year. One tailwind for bonds right now is that the Fed's benchmark interest rate is higher than inflation. Historically, that's been a good environment for fixed income. That said, the classic 60-40 portfolio has just come through its toughest stretch in history, capturing less of the market's upside than its downside. But long term, it remains a solid foundation for balanced growth and risk management. Alternatives and factor strategies like dividend growth, quality, and minimum volatility stocks have continued to shine. These strategies have historically delivered stronger downside protection, and that's valuable during periods of uncertainty. So what's the takeaway? 2025 has been a rebound year so far, but there are risks that still remain. The key is to stay diversified, stay patient, and keep your plan aligned with your long-term goals. If you'd like to talk through your portfolio, let's schedule a time to catch up. As always, thank you for your trust and partnership.